Higher interest rates proved challenging for many parts of the market, including real estate investment trusts. But now we have central banks cutting borrowing costs. Are the REITs starting to see some better performance? Joining us now to discuss is Sam Damiani, Director for Equity Research at TD Cowen. And for full disclosure on the companies covered by TD Cowen, a division of TD Securities, please see the website and the links at the end of this video. All right, so Sam, welcome back to the program. You and I have been chatting about these issues for a while now. We've got some rate cuts under our belt from the Bank of Canada, more in the offing. What's it meant for REITs?
Well, it's been a positive thing. You'll think back, the last appearance here was I think mid-June, and that ended up being a low. So hopefully this appearance today is going to be another sort of short-term low. When I was last here, we were talking about the coming rate cuts, and we were kind of surprised that the market hadn't started to price those in. About a month later, it started to price that in, and so going into sort of mid-September, the REITs had rallied significantly. I think up 25% from the low, roughly. But since then, we're about 7% back, and the bond markets, the yields have gone up a little bit over the last few weeks, but I think the long-term trajectory is supportive. We see the bond yields kind of migrating around the 3% mark on the long end, the short-term rates coming down, so we're quite constructive going forward. When we look from the beginning of 2022, when rates really started to rise, the REITs are still in the red, and we think that's still an opportunity, even though call it up 20% from the low today. We think there's still lots of upside. The P to NAV on average is 87%. Historical average is around 95, 96%. And the good news there is consensus NAV estimates really haven't started to move up yet. Over the last 2.5 years, cap rates have edged higher, and with interest rates moderating and stable and maybe declining at the long end, we see cap rates potentially starting to fall, which is positive for real estate values. So we see further upside as the P to NAV migrates toward that long-term average, and if NAV growth actually starts to accelerate positively, the sector could trade at a premium to NAV for a period of time.
Yeah, price to earnings, people know with equities, but price to net asset value, obviously a little more important in REITs. So overall, obviously, it's a rate-sensitive sector. We start to break down the different parts of the sector, though. How are they doing? Let's start with apartments.
Yeah, apartments are doing just fine. The headlines have been more recently been around the slowing population growth, so that's taken a little bit of shine off the story. But the demand is very strong. It's widely known Canada has a housing shortage. Occupancy rates at the apartment REITs are near all-time highs. But definitely the growth rate is moderating somewhat, but still expected to be toward the high end of our overall coverage universe. With FFO growth in the high single digits. So the apartment REITs are in good shape. They've been a preferred sector for many of our clients over the last number of years, and we're starting to see some clients looking at a little more diversification in their REIT allocation. And so it'll be interesting to see how it plays out, because the residential REITs, the apartment REITs, have been relatively expensive for good reason. We're starting to see that reverse a little bit.
All right, so let's talk about other parts of the market then in the REITs. The industrials, for the longest time I thought of this as an e-commerce play, but there's, that's part of it, but there's more going on here than just that.
Yeah, it's reshoring, manufacturing, supply chain resilience. There's lots of demand factors supporting, positive demand for industrial space. The market's kind of been treading water the last year and a half, with supply coming in a little higher than we were hoping for in the earlier part of the cycle, and the demand growth has slowed a little bit with interest rates, having peaked, and a lot of businesses just kind of went to the sidelines, slowing down their expansion or relocation plans. But so the combination of a little bit more supply, a little bit slowdown in demand, so market rents have flattened out. Some regions actually gone negative a little bit. But the great news about industrial is the rent growth over the last sort of 10 years has been so big that even if market rents don't grow, there's a long runway of cash flow growth as they continue to reset these leases to current market, like significant gaps to current market. So we're bullish on the trajectory for growth in cash flows for sure. And as the interest rate cycle sort of again moderates, demand growth we think will reaccelerate, and that will set up for market rent growth to resume, and the sector should become more in favor. We think that's going to happen within a year.
Now, I'm one of those people that when they moved over to e-commerce shopping during the pandemic, I just stayed there because this is easy. I never liked going to the mall in the first place, so I have to rely on you for the frontline details about what's going on in retail.
Yeah, retail is actually a sector that has been suffering for various reasons over the last 15 odd years. Be it Target, Zellers, Sears. E-commerce really came into its own over the last 10 years or so. But now we're at a point now where we see equilibrium, and the growth in e-commerce is similar to the growth in physical store retail sales. And so the landlords are seeing, the tenants, have seen dramatic growth in their sales in their store count. And some of the e-commerce is actually driven by the physical store. And many tenants have realized that and realized the importance of a store presence. You pair that with the population growth, which is obviously a net positive for demand, and the fact that almost no retail space has been built in the last 10 plus years. And so I think I've said this before, the retail space per capita in Canada is down about 6% in the last 6 years. So that's a tremendous factor in contributing to the tight leasing markets that we're looking at today. And occupancy rates in retail space are basically at an all-time high. And we're seeing market rent growth really accelerate to levels that I don't really remember seeing ever in my career. So this is a sector that we think is going to start to get more interest from investors, both on the institutional and importantly the retail side, because as investors cycle out of some of the money market fund and GIC's term deposits and looking for alternatives to get that yield, it's the retail REITs that are some of the best that offer the highest yields. And right now, we think some of the best growth prospects over the next couple of years.
This next bucket, a little more challenged coming out of the pandemic, perhaps longer than a lot of people thought, office.
I know where you're going. Office, it's been challenged, but the reality is the office REITs are probably up the biggest from their recent lows. And with this, let's say entrance into this rate cutting cycle that we've gone into over the last 3 months, I think there's a bit of a relief rally in those names because there was some balance sheet, maybe payout ratio concerns over the last year or two, and I think those are starting to abate. In addition, you look at CB Richard Ellis, they're pretty good at putting out quarterly detailed data on the industrial and office markets, and they've said publicly in their latest quarterly report that Canada will have positive office space absorption in 2024 for the first time since the pandemic. Wow. You pair that with a declining supply picture this year and then next year, and then after next year, there's basically no new construction of any consequence. So the vacancy rates are still going to go up as this new supply continues to be delivered, but it looks like we can see the peak, and that's important because once you kind of feel the floor in terms of occupancy, feel the floor in terms of cash flows and NAVs, I think that's going to bring some more confidence to the sector. But it's going to be choppy. So we're still a little bit tentative, in our recommendations on that space.
I only know my little universe, but I will tell you, at the corner of Bay and Front Street, the traffic is nuts, both pedestrians and vehicles. So take that for what it's worth. We're coming up in another earnings season. I mean, we're in earnings season right now. The big banks in the U.S. kick it off, but we're going to start hearing from these REITs. What are you expecting?
Yeah, this will be, I wouldn't say a major quarter. We're not looking for huge catalysts this quarter. When we look at AFFO growth in Q3, we're looking for about 4% for our entire coverage universe. But if we strip out the senior housing names, which have had huge growth as they recover, we can get into that if you like. But if we strip that out, because they're not REITs, the pure REIT space that we're covering, it's about 2.5% growth. So we think that is going to be the trough. And as we go into Q4 and into next year, we're looking at mid to upper single digits in AFFO growth. And so we think we're basically going to be at the trough. And the reason for the trough is the interest expense headwind that the industry has been facing over the last 2.5 years. Some cases interest expense is up 50%. It's at an extreme, but in sort of all points in between. But the vast majority of that headwind after Q3 will be in the past. And so with the strong fundamentals we're seeing in apartments, industrial, strengthening in retail, that strong NOI growth will flow through to bottom line FFO and AFFO growth, again, starting in Q4 and into next year. And there's a pretty visible runway that we see for a multi-year period of above average growth. So yeah, we're not really looking for the quarter to be super exciting from an FFO perspective, but certainly we're looking for indications on occupancy, leasing updates that will be instructive and informative to help firm up our thesis for 2025.